I started investing in equities, and so kind of the old school Buffett approach of analyzing the cash flows of a company, projecting out what you think is going to happen in the future, and then coming to a value of it. And I think there's a lot of value in that approach. The downside is that ever since that crisis, we've been in a very macro heavy environment, meaning that outside forces that have nothing to do with that company can totally change how that whole industry performs with massive kind of consequences if you're not aware of those macro forces. And so it's not as simple as saying, okay, I'm going to buy this bank. It's at a good price to earnings ratio. I think it'll go up over time, because you have to say, okay, what's going to happen with the yield curve, right? So what's going to happen with long duration rates compared to short duration rates? Because of course banks, they borrow on the short end, they lend at the long end. And we have big fluctuations in the money supply, big fluctuations in the yield curve from all these outside forces. So basically, we've been in this environment where we're at the end of kind of a long-term debt cycle, and the end is a process, right? It's not a given date, but it's this long process playing out where we build up so much debt in the system. Interest rates have gone all the way down to zero, in some countries negative. And so that's kind of the tail end of this really kind of multi-decade structure that's been playing out. And so when you get to that kind of end point, you have these really big macro forces. And so, for example, last year we had the big deflationary shock from the pandemic and the shutdowns, but then we had just as equally large fiscal response of increasing the money supply, giving out checks, doing all sorts of aid to try to offset some of that. And it basically, in order to navigate which sectors to be in, which stocks to be in, it really helps to have that idea of what's going on in the macro framework and what sort of bottlenecks are going to break, or what sort of sectors you want to be exposed to. And then from there you can go down and then do the individual company analysis to find out what kind of investments you want to be in. Yeah, so for gold in particular, its closest correlation is inflation adjusted interest rates. And so for people that don't know what that means, if you look at the 10-year treasury yield, right, so that gives you a certain yield over time. But it's people often mistake that they actually kind of basically increase their purchasing power by that yield. So let's say the 10-year treasury is paying you 2% a year, but inflation's 2%. Then your inflation adjusted yield is zero. You're just kind of treading water with inflation. And so that's a real yield. That's like the real yield of that 2-year treasury at a 2% inflation rate would be 0%. And so gold closely tracks real yields. And when real yields are positive, like back in the day, treasuries, let's say 20 years ago, treasuries yielded 6%, and inflation might have been 3%. And so you actually got a 3% real yield. So you did increase your purchasing power by owning those interest-bearing assets. And so that was kind of a rough time for gold, because gold, of course, doesn't really yield anything in most cases. It's kind of got that inherent, because it's scarce, then it's inherently inflation adjusted. But it kind of performs poorly when you can get a positive real yield from bank accounts or from treasury bonds. Now, as treasury bonds, their yields go down, and in some cases go below their inflation rate, well, then suddenly gold looks a lot more attractive. And so people buy gold, and the price of gold goes up. So if you chart gold over like a 50-year period, especially if you look at kind of the rate of change type of chart, where you see kind of changes in the price of gold over a set period of time, gold's closest correlation is that is inversely correlated to real rates. And so back in August 2020, real rates hit negative 1.08%, measured by the 10-year treasury minus the treasury market's expectations of inflation. And so that's when also gold hit a top. And then since then, we've had rising treasury yields, and they've been going up faster than inflation. And so gold's been in this kind of, this something like an 8-month long correction. But now, lately, those real yields have kind of been topping out, it seems like. And so gold's been finding somewhat of a bottom. And we actually had a really clean double bottom where, gold hit like a certain number, bounced a little bit, came down, hit that number again, and bounced up pretty strong. And so my base case is that I do think this correction might be over, and that we probably have more upside ahead for gold. But like you said, we can never really know. And so it's kind of about monitoring the probabilities of that. And for me, I'm also closely monitoring what the 10-year treasury does relative to inflation rates, because that's one of the main fundamental drivers for gold. And then when you take a step back and you say, okay, if gold does well, It's often the case that silver does even better. It's not guaranteed, but usually, when gold does poorly, usually silver does even worse, and usually when gold does well, silver does even better, at least over, a long period of time, like, 6 to 12 months or more. So I also like gold, silver. I like some other natural resources like energy, for example. And so I've been kind of, diversified among multiple types of commodities, including the precious commodities. I also like platinum, for example, while also being, in Bitcoin and being in other assets as well. We are getting some inflationary effects right now. I mean, if anyone looks at the price of lumber, for example, it's pretty much skyrocketed. And if you look at a broader set of goods, I mean, we've had, even the official CPI, which has some limitations in being accurate for inflation, but even using that metric, I mean, we're up 2.6% from a year ago in terms of inflation. And the Fed's policy right now is that they're purposely keeping rates at zero and creating new base money to buy treasuries and mortgage-backed securities until inflation runs over 2% for a sustained period of time, the way they measure it. And so they use core PCE to measure inflation, which is, it excludes food and energy. And so if those go up, then core inflation is lower than, total inflation. And so, basically until inflation is the way they measure it pretty hot for a long period of time, they plan to keep that those rates low. And that has a couple implications. One is if you're holding money in a bank, right? So you made roughly 0% last year holding money in a bank, while inflation averaged, according to official measures, 2.6%. And depending on your own basket of goods, like your own expenses, your personal inflation rate could be a lot higher than that, while your money is just not earning anything and therefore gradually, melting like an ice cube. And so if you look back in history, there are periods of time where you have, what's called financial repression, which is essentially purposely holding interest rates below the inflation rate for a long period of time in order to inflate part of the debt away. And so if you look back in the 1940s, for example, the United States fought World War II, and we built up a lot of debt from that, huge deficits. And, in order to keep financing costs low, the Federal Reserve came in and artificially suppressed the yields. And the reason they had to keep, interest rates low is if you have a country with 100% debt to GDP, for example, and if you're paying 5% or 10% interest rates on that, you're going to go bankrupt. You're going to spiral, and you're going to keep increasing the money supply, and it's going to balloon out of proportion exponentially. So what they do is they push down the interest rates, so that helps kind of keep the debt from spiraling too much, but it can be very inflationary. And so GDP can grow faster than the debt at that point. And so if you look back in the 1940s, you had an average inflation rate of something like 6%, and it included spikes up to as high as 20% during very brief periods of time.